Good afternoon, everyone, and welcome to today's SAVCA event. Glad you've joined us. And it's an exciting event and follows on from the previous event that we had related to the SAVCA Private Equity Industry Survey. I'm Tanya from Lill, I'm CEO of SAVCA, and I'm your host for today. And the last time that we ran an event, we looked at Volume 1, which was the strategic insights from our member base that completed the survey in relation to the private equity industry, past and future. But today we're going to look at Volume 2, which is all about the fundraising, investment, and exit activity within the industry itself. And to help us to look at the industry trends and to guide the conversation with us today, we have Sthembile Nkabinde. Welcome back. She's the founder and CEO of Khulasande Capital Partnership. We look forward to the interactions with you and the panel. And just a reminder, please use the chat function to engage with us. Use the QA box if you want to ask any questions, and there will be some polls that we ask you to participate in throughout the program. Sthembile, thank you so much, and over to you.
Thanks so much, Tanya, and thanks everyone for joining us this afternoon and for choosing to spend your time with us. So as Tanya has mentioned, we're going to unpack some themes in the second volume of the SAVCA survey. We're going to be unpacking 3 themes today. The first theme being fundraising in 2020 and what we can expect. The second theme we'll unpack is how has investment activity been impacted by the more challenging environment and shifts and priorities in private equity. And the last theme we'll unpack is funds returned and exit activity as it has and is expected to be impacted going forward. And to help us unpack these themes, I've got some esteemed panelists today that can help with this discussion. So I'm going to ask them to switch their cameras on as I introduce them. We firstly got Natalie Kolbe, who is a partner at Actis. We've got Gergana Ivanova, who is a Strategy and Transactions Associate Director at EY. And finally, we have Sefolo, who is the founder and CEO at Agile Capital. Welcome to our panelists. I'm looking forward to the conversation with you all. And as we'll be unpacking these themes as well, we'd like the audience to participate and to give us their views and insights. So we'll be having some polling questions which will come up. And can you please participate? Tell us what your thoughts are, what you think the answers are. We'd like to get what your views on how you've experienced 2020. So the first poll is actually up on screen. Vote and let us know what your thoughts are. So the first question is, by what percentage do you think fundraising decreased in 2020 in comparison to 2019? By what percentage do you think fundraising decreased in 2020 in comparison to 2019? And the second question, of the funds raised in 2020, what percentage do you think was from South African sources? Vote and let us know what your thoughts are. And while you're voting, I'm going to get some thoughts from our panelists on some quick fire questions. So Natalie, Gergana, and Tshego, these questions are to all of you. And if you can just please answer in that order, Natalie, Gergana, and then Tshego. Just a few quick questions to start off the conversation. The first question is, describe 2020 in 3 words. So in 3 words, what do you think 2020 was for you? Natalie, I'm going to start with you.
Yeah, I'm sure, Sthembile. When we were preparing for this this webinar, I think I like Maria's comment, which was a complete shit show, which I think probably summed it up really well. But from my side, I'd say disruptive. I think that's probably the single biggest word for 2020. Distressing. People lost their lives and their livelihoods. But I think opportunistic as well. Out of chaos, there always comes opportunity. So I'd say those are the 3.
Absolutely. I love the combination there, disruptive but also opportunistic. Gergana, what's your view? What are your 3 words?
Thanks, Sthembile. And I think very similar vein to Natalie, but my thinking was turbulent, yet encouraging.
Absolutely. And I love this mixture of the positivity, but obviously the challenges as well. Tshego, your view?
Interesting. Yeah. I want to say Control Alt Delete. But yeah, maybe not as bad as that. I'd say a hard reset. I think, it certainly requires a hard reset. Yeah, it requires us to rethink what's currently happening.
People love to do that. Hey, start over.
Great one.
Start over.
A redo would be great. And what's the most interesting trend that you noticed or you thinking that will happen in 2022 in PE? Natalie, Gergana, and then Tshego.
Definitely the acceleration of digitization. I mean, everything went online during the pandemic. So that is, I think, is going to be a big theme in everything we do in PE.
Absolutely. Tech. Gergana, your views?
Also looking at an acceleration, but my very optimistic prediction is going to be accelerated exits coming through in 2022 rather.
We'd like to hear that as fund managers. That's a great prediction. Tshego, your views?
Yeah, interesting. I mean, I actually agree with Gergana. I think exits and realizations. Yeah. So a lot of people that are sitting on assets that at some point are going to have to realize value. So I definitely agree with that.
Great. Some great predictions there from our panelists. And the last quick fire question, one word to describe how the PE industry has changed in the past 5 years. Natalie, again, I'm going to start with you.
Sthembile, I'm going to use the word consolidation. I think I don't know if that's quite the right word, but certainly at the larger scale private equity, which is obviously where Actis operates. You know, we've seen the coming together of Ethos and Brait. We've seen obviously Actis take over the Abrage assets. We've seen Carlisle, exits, Stanchart exits. So I think that certainly at the top end of the industry, there's been a consolidation.
Gergana?
Definitely a tough one. Thought about it quite a bit, but if we look at the greater scheme of things, private equity being a fairly young industry globally, my one word was matured. I think certainly seeing level of maturity coming through.
No, certainly I think our industry has matured over the past couple of years, especially in South Africa. Tshego, your views? One word.
Yeah, I'd say competitive. And it's probably along the same theme, as what you've just mentioned. I think there's just been a proliferation of players in the market who've just, they've just created competition, which I think is a good thing. Yeah,
absolutely. And you see it in processes, right? That there's so many people looking at similar assets and striving out prices. So let's pull up the results and see what the audience thoughts in regards to our first few questions. So interesting that most of you chose 15 to 30% as being the percentage by which fundraising decreased in 2020. And it looks like most of you thought that 20 to 40% was the percentage by which the funds raised was from South African sources. So let's see what the answers are. Let's pull up the answers and see what the answers actually are. So we can see that the answer there is actually 22.2% is the number by which the percentage of fundraising decreased in 2020. It's still encouraging to see that 2017 and 2018 were still lower than 2020. So albeit it was a tough year compared to 2019 in regards to fundraising, I think it's not as bad as I thought it would be. So still encouraging results to see that the decrease wasn't as substantial as I certainly expected. Let's see the answer for the next question. So of the funds raised in 2020, 72.5% was from South African sources. Again, very encouraging to see that a lot of local institutions, especially our pension funds and endowment funds, are supporting local fund managers. But it is worrying to see that we're not getting as much support from international investors. So let's unpack these themes a little bit more with our panelists now. Natalie, I'm going to start with you. So fundraising was cited as one of the biggest challenges the industry faced last year in our previous session. What are your views on the current fundraising environment, and have you had to do things differently in this regard?
Sthembile, let me start with the last part of that question. I mean, have we had to do things differently? Absolutely, yes. I mean, the one thing that COVID did, or 2020 did, is it threw a bomb into what was, kind of the normal pace of and the normal way of fundraising. And there's just like a very practical change, which I think is actually very good for the industry, in that fundraising went online. Normally before you've had to physically be in front for your first meeting. And, I just recall when we were fundraising for our current fund, it was brutal. I mean, you were spending 3 to 4 weeks in the US doing 2 cities a day. It's airports, it's taxis, it's checking in at these businesses, just wasting a lot of time to only be told halfway through the meeting, like, oh wait, we don't do Africa, so it's I do think it's LPs have been forced to go online. We've all been forced to go online, and they've got comfortable with it. And I think that's going to be a permanent shift in the way that people fundraise, and that certainly the earlier stage meetings where the LPs and GPs are getting to know each other and to understand what the mandate is, I think that's going to go definitely online. However, it is important that, that GP-LP relationship is a very important relationship, and it's built on trust. So, it's difficult to build trust over Zoom. So I think, there will be in-person meetings, but it will be later on in the process when there's more certainty from both sides. I think it's just going to condense the time wasting that used to happen in the industry. I mean, the fundraising, particularly for Africa, has got hard. I mean, I think, you saw it in the surveys, particularly from foreigners, foreign direct investment. I think a lot of LPs looked inward to support, and they held on to their capital to support their portfolio companies, to make sure that if their GPs came for more money, that they would be able to support them. But saying that, they have to allocate capital. These are allocators of capital. They've got cash coming in, whether it's from the pension funds or from through the DFI community. They do have to allocate. So at some point, the tap has to open. It's probably not going to open in a gush, but it is. I do expect that fundraising will, and we can see it's already in the survey, that it will start to turn and come back.
So Natalie's thoughts there that the fundraising environment will come back, but certainly a lot of time being saved through having online meetings. Certainly agree with that. Tshego, I'm going to move on to you with the next question. Do you think fundraising will increase or decrease in 2021? So we've heard Natalie's views on that. So if you compare 2020 to 2021, what are your views on the fundraising activity? Increase or decrease?
Look, I think the fundraising activity itself is likely to increase, but the quantum of funds that people are likely to raise, I think that's a different question. And I think it's a function of, of several factors. Firstly, there's just that many more people that are trying to raise funds in the market. So that in of itself presents competition. But then, the fact that, things are being done remotely, I think that's quite a big challenge for most fundraisers. So you're going to find that it takes slightly longer. And as a result of that, there's just going to be that many more people that are out there that are trying to raise funds.
Thanks for that, Tshego. I'm going to stay obviously on the fundraising theme, just both to you, Natalie, and Tshego. So global PE fundraising actually increased, which is a bit different to what we've seen in the SA market. So what do you think South African PEs can do to tap into that global PE fundraising peak that we saw last year? Because clearly we saw in the graph that local sources are the ones where most PE fund managers are raising funds locally, but we're not tapping into that global PE market. How can we change this as SA fund managers? Natalie, you can go first, and then Tshego will get your views.
Yeah, I mean, look, 2020 turned everything on its head, and businesses have had to, the big word for 2020, pivot, to something different and something new, and have had to, take on the challenge of COVID and see how they can, change their businesses into a different business model. And some of them have actually been really successful. And I think a lot of businesses will leapfrog some of the traditional industries and end up doing better than they had done before. And we've seen that in our portfolio, where, nimble managers have changed the way that they do businesses and taken advantage of the change in the environment. And I think that's going to it will have to trickle down or trickle up into the private equity industry. We're going to have to do things differently and look at these sectors differently as well. So, this point that I made around digitization and moving everything online, that is a theme that is staying and is not going anywhere. And as private equity, we're going to have to be nimble and change the way that we look at businesses and back those businesses and back that trend, and pick the winners that, that are able to do that.
Tshego, can you come in then on your?
Yeah, I mean, it's a very interesting question, but I think the question we should really be asking is, if that's the global trend, why is South Africa backing that trend? So, there is a conversation to be had around COVID and the impact of that. But I think there's a bigger conversation around the macroeconomic environment and where South Africa finds itself. And the reality of it is that at this point in time, trying to sell a South Africa investment case as your thesis is quite a challenge. It'll be quite interesting as we get into the survey and we start talking about the quantum of funds raised locally versus internationally, and what the observations are there. Because for anyone trying to raise a fund out there, I mean, the issues in South Africa are very well documented and understood. And unfortunately, investors are looking for a return. And as a result of that, they're going to direct their money and their capital where they think they're going to get a return. So that is a consideration that I think has had an impact on this.
No, definitely agree. The SA Inc. is what we need to solve first before they look at the fund managers. So that is a challenge, just given where the country is at this point. Thanks for those views. Gergana, I'm going to move on to you. Who's investing in alternatives and in particular in private equity? Are we seeing more funding coming from local or international investors? So kind of staying on the same theme, international versus local. And we've seen the survey results. Maybe just give us a little bit of color on international versus local investors.
Yeah, absolutely, Sthembile. What we're seeing is definite contraction in the allocation of funds to emerging markets, and Africa and South Africa, obviously suffered in the fundraising in that space over 2020 because of various factors that are specific to what happened in 2020 with the COVID headwinds, but also the more, I suppose, more macro factors that Tshego was alluding to, where the returns coming from. Are we getting that from Africa? What is the impact of exchange rates and how that's eroding returns? So what we've seen on the results from the survey is actually very encouragingly the local investment community, and specifically to your point earlier, the pension funds and endowment funds in South Africa were really the biggest contributors to the fundraising that we saw in 2020, coming in at about 53% of the total funds raised. And then the next biggest contributor has been, historical support of South African and African fundraising, the DFIs coming out of Europe and UK. But what's been really disappointing is the US not coming to the party in 2020. It has been a significant contributor to fundraising. That market historically, up to 30% going back to 2018, very little coming through in 2020. And then the other point is the rest of the continent, investors from the rest of Africa didn't really feature at all. And that's something that, to convince the rest of the world to actually invest in the continent, there needs to be more cross-investment, within the continent itself.
No, very valid point. They're very worrying to see that a lot of the other African institutions outside of South Africa aren't supporting African fund managers. So certainly we need to have confidence in ourselves as a continent first in order to attract investment outside of Africa. So very good points there, Gergana. Thanks for that. We're going to move on to our second theme now, which is how has investment activity been impacted by the more challenging environment and shifts in priorities in PE. So again, we're going to start with a polling question where we'd like you to participate as the audience. The first question being, which sector do you think attracted the most investments in 2020 by Rand value? Which sector do you think attracted the most investments in 2020 by Rand value? So we've got some options there for you to choose from: infrastructure, real estate, services, telecoms, energy and related, or other. Let us know what your thoughts are. And the second question there is, what was the value of new investments in rands made in 2020? And we've also got a couple of options there. I think we need to move the screen up a little bit just to see the other options, because we can only see two options. Can we move the screen up a little bit just so that the audience can see the rest of the options? Okay, so we'll just go with the two options. You only have two options for question two. It doesn't seem like we can move up the screen. And while you are debating in your head which of those options you want to choose, I'm going to do some quick fire questions. It seems like you can scroll down to the latter options. So it doesn't seem like it's something that we can do, but you can scroll down to get all the other options as well. So some quick fire questions again to the audience while we wait for those answers. What do you think the top investment sectors will be in the near future? Natalie, I'm going to start with you, then Gergana, you can go after Natalie, and Tshego, then you can come in after that.
So Sthembile, from a value perspective, I think infrastructure, clean energy, that's, those are obviously sectors that can absorb a lot of dollars. And there's a lot going on the continent when it comes to, that's a big theme for investors globally, is climate change. So clean energy, renewable energy, etc. And then obviously, the infrastructure on the continent all needs upgrading, ports, etc. So I think from a value perspective, that is the sectors that will get the biggest dollars. I mean, from the other sector that is booming on the continent, and in South Africa as well, and it talks to this trend towards digitization, is the VC sector, the tech sector. But obviously those take much smaller checks. So I think those would be, from a volume perspective, I think there'll be a lot of investments that's going into the VC tech space.
Absolutely. Gergana, your views?
I'm definitely in alignment with Natalie there. I think infrastructure and tech certainly expected to feature highly, and I guess the midpoint between the two is that data center infrastructure within tech itself, which has also been growing quite significantly. And if we look at globally, that's really where a lot of the investments come through in tech. But obviously, in the African context and South African context, to Natalie's point, it is going to be in the VC space. I guess other needs on the continent is financial services, so fintech, payments. We've seen a lot happening in that space, and with continued innovation, you know, there's likely to be more investment coming in, and obviously education. You know, it's featured very highly previously, and there's a big need across the continent and in South Africa. So we could see more happening in that space as well.
And Tshego, your views?
Yeah, I think telecommunications and connectivity. I think given, you know, where we currently find ourselves, I think we're all realizing that just being connected and able to interact is suddenly, you know, quite important. So, you know, I'd imagine that trend is going to develop even further.
So quite a similar tech kind of trend weaving in between all the panelists, which is, I suppose, we're seeing a lot of that, and especially telecoms, VC, and certainly clean energy as well. Let's see what the answers were from the audience on our polling questions. So most of the audience are thinking, well, actually, there's a tie between infrastructure, telecoms, and energy and related in terms of the sector that has attracted the most investments. Quite interesting that there was a tie there. And in terms of the value of new investments in 2020, most of the audience thinking that it was about 7.8 billion rand, 36% of the audience, 33% going with 10.2 billion rand. So let's pull up the answers there and see what the actual answers were for these questions. So for the first questions, investments by sector, infrastructure there clearly being the winner. So infrastructure and real estate actually made up 41.7% of the total cost of total investments in terms of the cost. But by number, interestingly enough, services and manufacturing were the most popular sectors in 2020. And in regards to the value of new investments made in 2022, let's see what the actual answer was there. So 10.2 billion rand being the number, or the value rather, of new investments. Although there was a decline, I think that number is still very encouraging. I think a decline would have been expected from 2019, but I think it's still a very encouraging number to see that there were a large number of new investments coming through from PE fund managers. So we're going to move on now to more specific questions for our panel. Tshego, I'm going to start with you on this section. Do you think fund managers and management teams understand the risks that have been brought about by COVID-19 for future financial performance? I mean, we still all trying to navigate this COVID-19. We don't understand the impacts. Do you think that management teams understand the risks posed by COVID-19 in the short term, medium term, and long term, and fund managers as well, because both management teams and fund managers need to work together in navigating this new environment that we find ourselves in?
Yeah, I mean, it's a very interesting question, Sthembile. I think when it comes to short to medium term, there's a very clear understanding of you know, what the impact and the implications of this is. You know, we've been through the first, second, and we're now going through the third wave. So we know what the, you know, what the impact is on business. I think what we don't understand, and you know, same thing applies to management teams, is what business is going to look like going forward. You know, is it, you know, everyone's talking about the new norm. What is that going to look like? Are we going to have to live with this consistent cloud of COVID going forward, or are we ever going to return to a scenario where things get back to normal? And that's something that we don't understand. And quite frankly, if I look at our portfolio of companies, you know, whenever we have discussions, it's always, you know, around, we need to make sure that we're prepared for the unforeseen, you know, circumstances. So we just don't know. I think that's the reality of it. Yeah.
No, I mean, I think we really don't know. That really is the reality. It's just navigating and taking it as it comes. Natalie, I want you to come in there. What is your view on what the challenges will be in regards to deal activity in 2022 rather, and beyond? So in this year and beyond, what's your view on deal activity and the challenges thereof?
Yeah, so Sthembile, I think that the environment for deal activity is good. For one reason only, and that's the fact that for the whole of 2020 and partially 2021, private equity had to kind of look inwards. We all kind of looked inwards and kind of stopped doing anything external and just really focused on making sure that our portfolio companies could get through what was probably the biggest crisis that they would have ever faced. So the exit and deal-making activity would have slowed down during that time because everybody was kind of just holding on to capital to make sure that they could protect and sustain their businesses. But private equity, we've got funds that we've raised and we need to deploy the capital, and we need to exit. So that kind of backlog of deployments and exits, I think, will come. So, and the other thing that's happening as well is that through this time, corporate South Africa has also looked at their strategy. There's been a whole new strategic shift, and we've seen it, news coming out of the big corporates as to how they're kind of shedding non-core assets and re-strategizing. So that environment, I think, makes for a very healthy deal activity. I think that the deals people can deal. I think the biggest challenge, though, will be buyers and sellers finding themselves on value, because trying to figure out what sustainable profit is in this environment, it's almost impossible, because 2020, like, everything blew up. And then in some cases, 2021 has been like the best, most profitable year ever for them, because either businesses pivoted, the famous word of pivoted, or they, there might have been a backlog in demand for their product. Now, what is it? Is this a new sustainable level of profitability, or is it just a backlog that's going to clear and, we're in trouble again, or if COVID comes back? So I just think there's going to be, it's not as easy to value businesses, and mainly because you just don't know what sustainable profitability is. So I think that's probably going to be the biggest challenge in the deal-making environment. And I suspect on the back of that, you might find some funky deal-making structures where there's, profits, warranties, and, delayed payments, achterskot, whatever you want to call it. So I think that's going to start becoming a bit more of a norm than just paying a price on day one and moving on.
Yeah, I mean, I think it speaks to what Tshego was saying, that we just don't know. So guessing what sustainable earnings will be and then trying to value a business on that basis is very, very tough. I agree with you 100%. And so a lot of deal structures will definitely come into the market. Gergana, I'm going to move on to you with the next question. How has the current environment impacted pipeline development, like exploring new investments and investment choices?
Yeah, that's a very interesting one, Sthembile, because like Natalie said, a lot of the focus over 2020 was inward looking, trying to protect and manage the portfolio companies, trying to manage downside risk. And there wasn't as much looking to pipeline and looking to deploy funds. But more broadly speaking, if we look at the dry powder that's available in the market, it's definitely not as extensive as what we see globally. I mean, globally, we're talking about some staggering numbers. We've got close to $1.94 billion of dry powder available to invest. And, a lot of the private equities that we see locally don't necessarily have, a lot of those funds to deploy. And I guess with COVID, finding a way to source deals has been one of the challenges. When you're not out there in the market, meeting people, meeting participants, finding new ways to actually source deals has definitely been one of the things that, a lot of the firms have had to work out. And I guess the last point is, maybe the actual space for pipeline and developing pipeline is a bit smaller, because the industry and the sector has grown quite dramatically over the last 5 or so years. And, actual potential targets and companies that haven't had a round of PE investment is contracting and getting smaller. So in terms of how you build pipeline going forward, we might see a lot more action in the secondary space.
No, interesting view. I mean, I think it speaks again to the competition in the market, that we're seeing a more mature PE market in South Africa, which will be good for exits, but obviously will not be so great for deal activity and building a pipeline, especially when it comes to to pricing. You know, those that like to have low entry multiples may struggle in this next phase. Natalie, I'm going to come back to you. So there's a lot of activity in digital infrastructure. And I know that's one part that Actis is focused on. Can you explain some of the investment rationale around digital infrastructure? And globally, there obviously also has been a move towards tech. We spoke about that in terms of sectors where you think there'd be a focus going forward. Do you see an upward trajectory in tech going forward? And I think your view was already shared there. And how is South Africa comparing to the rest of Africa and other EMs in regards to this kind of tech focus and digital infrastructure trend?
Yeah, so I mean, look, there's the march towards tech enablement and digitization was happening long before COVID hit. COVID just accelerated it. So, you know, anybody who wasn't having a conversation in their boardroom about what is our digitization online strategy we're forced to have it. So I think just the whole world it's accelerated to an online digital world. But that was happening before anyway. And you know, but the reason, you know, so obviously as Actis, I mean, it's not just us, there's a lot of people that can see this trend. It's an obvious trend. But the one of the constraints to that on the African continent is the cost of data. The cost of data on the continent is still high compared to the rest of the world, but also the reliability of that data. So getting, you know, infrastructure in place is super important. And there is, you know, we've taken a very strong view that this is an area that we want to invest in as Actis. So we've committed $750 million to this globally. And here on the continent, you know, we recently announced, or, you know, towards the end of last year, announced $150 million investment into Octatal. We're also building a large data center on the continent to really support that trend. And others are seeing that as well. I mean, there's, you know, Google and Facebook through their subsidiaries have also, you know, announced these massive undersea cables that are coming to the continent that's going to boost the connectivity, the reliability of that data, and also bring the cost of data down. Now that's important for the continent because that is the backbone on which any tech company can build on. Because at the moment, one of the biggest challenges to tech-enabled businesses is the cost of data for the end consumer. You know, at any one point in time, 50% of the South African population is without data. You know, yes, they'll buy and it's that, but half the population in South Africa at any one time doesn't have data, and it's because of the cost of that data. So this is transformative. I think this is probably going to be the single biggest trend that's going to be positive for the continent, because it brings tech, lowers the cost of accessibility, lowers the cost and improves the accessibility for, you know, for any service, whether it's education, whether it's healthcare, whether it's a financial product. So I mean, we are super excited about this trend because where Africa, I think, is ahead of the curve is because there's a lot of kind of legacy industries that have not yet taken a foothold on the continent. And we're going to be able to leapfrog those industries. You know, so think about universities. I mean, I think it's going to be unusual to build the kind of, you know, big leafy suburban universities, the kind of which you see all over the developed world. I suspect that won't happen in Africa because it's just going to go straight to online. So there's just a huge amount of disruption and leapfrogging of traditional industries, which I think is going to come from this, you know, this tailwind of digitization.
And how do you think we compare to other EMs, Natalie? How does Africa compare to?
I mean, look, we are still small from a tech space, but the activity in this space is phenomenal. I mean, it's kind of doubling every 5 years. You know, so it's growing. Any metric you look at in the kind of tech and digital world is growing, and it's growing phenomenally well. So Africa has got a very entrepreneurial culture. You know, I mean, I think it comes from necessity. You know, often, and that necessity of entrepreneurship is built into, you know, everyone on the continent. So that, I think that that has spurred the growth. There's just a huge amount of activity in that space. And South Africa is up there. You know, 70% of the activity happens in Kenya, Nigeria, and South Africa. And, you know, it kind of swings between Kenya and, you know, between the three, depending on value, volume, etc. But we are right up there. You know, we've got fantastic engineers in South Africa. We've got great talents, and the businesses that are coming out of that arena, you know, is great. And we've got good data and good connectivity, you know, compared to some other countries. So I think we're up there, and I think, you know, it's a great kudos for South Africa, and it's a big opportunity for investment.
Great, thanks for that. I'm going to move on to Gergana again on the next question. So Gergana, the value of investments has decreased, as we would have seen in the results there. Is this simply due to COVID, or are there other reasons that you can cite as to why the value of investments has decreased? How has the 40%, or how does the 43% rather decline in the value of investments compared to the rest of global PE deal activity?
Yeah, look, I think we've touched on some of the points already, because, you know, some of it is because of COVID. We know that there was a lot of focus on portfolio companies, you know, protecting that downside risk, you know, reserving capital. And there are broader reasons. You know, the one is to be able to raise more funds, to be able to deploy and increase investment. We do need to have more exits, and to demonstrate being able to return value, being able to execute exits successfully. And there's also the point around valuations. You know, there has been volatility in valuations, and perhaps some disconnect between buyers and sellers, which is making it, you know, taking longer time to actually conclude deals. And sometimes the deals don't get concluded, which is impacting that investment number that we're seeing locally. But hopefully there's a lot of light at on the horizon, especially when we look at the global landscape and what's happened globally. And hopefully we see that translating within the Southern African context as well. And if we look at those numbers, over 2020, there was actually a 7% increase in investments. But it was really a tale of two cities, or two halves, as we've been speaking internally at EY, because if we look at the first half of 2020, there was a big contraction in terms of investments. You know, there was about 30% decrease, and then a big rebound in the second half when confidence returned, when people figured out their new normal. There was some pent-up demand, and we saw some staggering numbers, you know, about 46% increase in the second half of 2020, and then that continued into 2022. With the latest results of the first half of 2022, we're seeing 53% increase in investments globally. So hopefully, you know, given that we tend to lag in terms of these global trends, sometimes from a Southern African context, we see a lot more investment coming through in 2021 and onwards.
Perfect, thanks for that insight. So I'm going to move on to you in regards to follow-on investments. So we've observed, and we'll see in the survey results, that there has been more follow-on investments made by PE fund managers by investing in the existing portfolio companies rather than deploying into new assets. Why have fund managers chosen to rather deploy into the existing assets as opposed to deploying into new assets? What's your view on this?
Yeah, I think it's twofold. Yeah? I think obviously, you know, the first part of it has to do with the fact that you already invested in a business. To the extent that you need to put in follow-on investment in order to preserve that value, then you have to do it. Obviously, the danger with that is, you know, sometimes you end up putting what I call good money after bad. Yeah. So you have to have the discipline to say, well, we must actually accept that, you know, the investment that we made was bad in the first place. And irrespective of what's happened with COVID, we need to get to a point where we say, fine, we're not putting any more money into it. But largely, it's been a function of managers wanting to preserve value and making sure that they support their businesses so that they can, you know, ride this wave and come out of it okay. The second part of it has to do with the fact that, you know, and Natalie kind of touched on the point earlier on. You know, it's quite challenging at this point in time to pin, you know, value down. You know, you just don't have a sense of where value is because of historically and in the last 2 years what's happened. So as a result of that, it's that much more easier to justify putting money into an existing investment. I mean, we do it, you know, we do it all the time. You know, you understand the business, you understand the management team, you understand the risk factors. So quite frankly, presented with an opportunity to put in additional capital into it, I think it's a safer bet than going into something where, you know, you ultimately either you get the value, you know, completely wrong, or, you know, you don't understand the risk profile of it. And I found that, you know, as a result of that, a lot of people are actually looking inwardly into their portfolio, and they're saying, well, if we can increase our stakes or support our businesses so that they themselves can go and make further acquisitions, that tends to be the preference as opposed to, you know, going out and deploying new capital. Yeah?
So again, it's that inward looking. Natalie, how have you experienced this at Actis, this trend on following investments versus new investments?
I mean, definitely 2020, you know, that was it just stopped, right? I mean, there was very little activity. around exits and new capital. But private equity, you know, we've raised funds and you have to deploy it. I mean, you can't, you know, we can't sit on the money forever. I mean, I think there is a preference, as Tshego said, to support the businesses that you know that it's easier, etc. But we have seen this year, I mean, we've launched some exits within our portfolio, and we are getting strong interest, and people are pitching up for the process, with quite quite strong interest. So I do think, I mean, we're probably going to be coming out of this, putting money into portfolio companies. I think that trend will continue, but there will be a move towards looking to what's new and what else we can deploy, because there is we do have to deploy the capital.
Yeah, I mean, it speaks to the dry powder in the market with people holding on, and the dry powder does need to be utilized in some shape or form. But I mean, to Tshego's point, it does make sense. You know the assets, you know the management team, you know the risks. So I think in a time of uncertainty, it probably makes more sense for fund managers to say, I'll deploy into an asset that I know and understand, rather than going into a new investment. Tshego, just in regards to BE, which we've seen has been a huge trend, obviously, in South Africa from a PE perspective, with a lot of BE players coming up. How do you think BE considerations have impacted the South African PE landscape?
Yeah, that's an interesting one, particularly given some of the views that we've gotten coming out of the Competition Commission, right? So clearly it still remains very relevant and topical. And in fact, I'd argue very strongly that anyone looking to do a transaction, whether you're trying to sell or buy, I think you'd be very naive to think that BE and empowerment is not relevant. So it's clearly something that you need to consider as part of the transaction that you're doing in a South African context. I do think that the landscape is starting to mature. So if I think back to 10, 20 years ago, the universe of buyers from an empowerment point of view that we had was quite few. It's only a handful, yeah. Whereas in this day and age, if we're thinking of selling an asset, there's definitely much more people out there that we can talk to. So your addressable market, I think, is getting to a point where where it's maturing, which is good, because then what it indicates is that when you buy assets, BE is no longer one of the risk factors that you have to flag, where it clearly is going to become difficult for you to to realize value. So yeah, I definitely think that it's relevant. We've also seen that it's been a catalyst for transactions. Some of the deals that we've seen are driven, purely on the basis that people are wanting to empower their businesses, and that's why they're talking to us. So still very much relevant and topical at this point in time.
Absolutely, no, very, very relevant. And as you say, the Burger King Comcom decision kind of spurred this conversation.
I wasn't going to mention names.
Let's not mention names. I'm going to go to some of the questions that we got from the audience. The first one is from Vera Shaba, and she says, "Hi, team and panelists. Thank you for this. My question is ESG. Was there a trend towards investing in funds with ESG metrics? And what about climate lens and gender lens PE funding or fundraising?" Gergana, can you take that question for us?
Thanks, Sthembile. That's certainly a really, really interesting one. I mean, ESG is just so topical at the moment, and there's so much focus on, is it just a tick box exercise, or is there actual value? And I think there's definitely been a shift in perception as to what is the value of ESG, and really looking at each of the components, because often there's a lot of focus on the E, but there's the S and the G as well. And especially in the Southern African context, I think the S becomes a lot more important. And it also speaks to the change in type of investor and investor perceptions. So there's always been having a strong ESG framework for your investments has been a prerequisite to be able to fundraise in the European context, with the DFIs having certain expectations. But I think there's a lot more happening with platforms that allows the average person to start participating in investment. And with millennials coming into the fold, we see a lot more expectation of responsible investment, of impact investment. And as much as this survey itself didn't necessarily in this volume have focus on that, and we don't have specific tangible results. I think it's definitely very topical on the global landscape, and we're seeing it becoming a lot more topical in what we do locally. If I think of some of the work that we do for clients from an EY perspective, setting up these structures and making sure that you are investing responsibly, that you're compliant with UNPRI and various frameworks out there, is definitely something that enters the conversation a lot more often these days.
Definitely a topical conversation with fund managers and DFI specifically pushing this agenda quite a lot. Natalie, your views on that and ESG metrics, climate lens and gender lens PE funding or fundraising?
Yeah, I mean, Sthembile, I think that those three have actually morphed into the ticket to the game, as opposed to being able to differentiate yourself on any of those metrics. I mean, we've obviously been fundraising through Actis, and the DD questionnaires that come through, regardless of what you are, whether you've got, if you've got no climate change, the questions come. I think if gender is a big part of it. So if you're an all-male team, they'll ask you, what are your plans? How are you going to change this, etc. And ESG is just, it's a given. So I think there's, funds that want to raise on a ticket of ESG or gender, I think alone, I think is going to be difficult, because that is morphed into become the ticket to the game. That it's kind of the minimum that you have to, criteria that you have to meet for an investor, particularly the DFIs to talk to you.
Absolutely agree there. We've got a question here from Graham, who says, given the sectors mentioned, it would be interesting to hear from panel speakers on the future of PE investing in some of the sectors that had a lot of PE investment previously, like manufacturing or industrials, especially in South Africa, where industrials has been a huge PE sector focus for a lot of PE fund managers. What are your views on those sectors still staying relevant, manufacturing and industrials in South Africa? Tshego, what are your views? What are you seeing in the market?
Yeah, I mean, it's quite interesting. So clearly what we've seen of late is what I call, sector specialist funds. Yeah. So, you're either looking at an environmental fund or a healthcare fund. And there's a clear realization, from people that if you're trying to raise funds in a South African market, the idea of being a generalist, is becoming quite challenging. I think when you start talking to, the investor community, they want to know that there's a niche that you're targeting. So as a result of that, a lot of the capital that's out there is also earmarked and targeting specific sectors. So, are these particular sectors still attractive for private equity? Yes, but also argue very strongly that you've got a lot of capital particularly in South African context, that is looking for, for specific sectors. Whether you're talking low-cost housing, you're talking, healthcare. I think there are specific investors that are looking at those classes of assets to invest in.
Yeah, no, I mean, certainly a lot of the PE fund managers have been generalists because of our small market, but we are seeing some of those sector focus and a push also from institutions to have more of a sector focus. Natalie, we've got a question here specifically for you. It says, given your role in Actis on what's your views on investment activity in South Africa versus the rest of Africa and the other emerging markets? Any key things SA-based PE should learn from other EMs?
Sure. Thanks, Graham. The biggest, South Africa, Inc., unfortunately falls a little bit between the cracks. We are not viewed as developmental enough because of the kind of, the state of development, which is good in South Africa. We've got a good, decent infrastructure, decent financial system, all of that. So a lot of the DFIs are not interested in investing in South Africa because we're not seen as being developmental enough. But we're not developed enough to attract some of the more institutional capital, like the pension funds, because they kind of shun South Africa. So it's quite difficult for South Africa, specifically South Africa only PE firms to attract capital globally, because we kind of fall a little bit between the cracks here. So there is, I'm trying to think about what we could learn from other markets. There is, the one thing we also don't have is growth, right? So, an investor coming into the country would want growth as well. So I think, really moving ourselves into areas where there is strong growth, I think would help a lot. And I think this is where, we've spoken about this at length, where backing the kind of newer age industries, tech, etc., I think would be helpful. And we've seen, obviously, in India, that's been huge, and we've seen it in China. Those sectors are the sectors that have attracted a significant amount of capital and where a lot of the growth is happening. So I think just being more nimble-footed around that kind of acceleration into that world, I think that's probably a trend that we can jump on.
And I suppose, the challenge is that we also have a small population base. We're not like in India that has billions of people, well, not billions, but like a billion population, or China. And so developing something in India or China, market size is quite big. Yeah. We are much smaller. So you develop something, you only have 60 million people that can consume that, possibly. And obviously the market size depends on what you're trying to consume. So I think that can be a challenge in comparison to other EMs, and why certain institutions would rather put their money in India or China, just because of the possibility of good returns there versus South Africa. So I think it can be.
The one thing that South Africa has got going for it, we have a very good base of very talented people, and that have come through, in certain parts, a decent education system. So there's a huge amount of talent here, and it's a lot cheaper than China and India, that are our counterparts. So being able to kind of nurture that talent, and be bold about taking it beyond the South African borders, and really like trying to grow into, whether it's Europe, using South Africa as a base for whether it's manufacturing or services, and taking that into the other parts of the world. I think that's an area that we can excel, just given, as you said, Sthembile, our smaller population.
Definitely. No, we certainly are a very talented country. I'm going to move on to a question here from Rufense, who says, given the current outlook of the industry, I'm assuming she means the PE industry, what does the competitive space look like in terms of barrier entry levels for startup firms now and in the coming years? Gergana, do you want to take that one for us?
Yeah, so barriers is an interesting one, because I guess what the industry really needs to demonstrate is the ability to exit. I think that's probably one of the single biggest barriers as such to raise more funds, which is really what you need to be able to do to enter the sector. But that being said, like we saw in the survey results, and we're seeing increasingly, is local interest in going the private equity route, because of returns being better than what we're seeing in some of the other investment sectors. So we're seeing a lot more local pension funds and other investors wanting to enter the space. So I guess the entry level is probably local for new players and smaller players coming in. And then once you can demonstrate being able to invest well, value creation within your investments, being able to grow them, whether it's bolt-ons or other levers of value creation, operational levers, and exit successfully, then that opens up the doors to actually be able to raise funds on the international stage. And that's when you can really grow and become one of the bigger players. But to me, the biggest barrier is really being able to demonstrate those exits to get a foothold, and then you can keep growing from there onwards.
No, so that's a good segue into our next theme, which is around funds return and exit activity, as it has and is expected to be impacted in the next couple of years. So let's get our polling question and get our audience participating again. So the next poll is around, what do you think was the most popular exit route in 2020 by number of exits? Sell to another PE firm or financial investor, sell of listed shares and IPOs, sell to management or management buybacks, share buybacks by portfolio companies, or trade sale. Let us know what your views are. And while you are thinking on that, I'm just going to ask a question to our panelists around IPOs as a viable exit option in South Africa. We haven't seen a lot of these, and maybe I'm giving the answer away a little bit here. We haven't seen a lot of IPO exits in SA. Is this really a viable option? And if so, why is it, or why isn't it a viable option? Natalie, I'm going to start with you.
So Sthembile, it is definitely a viable exit option. There is there is a captive market within South Africa of asset managers that need to deploy, and they've got capital and they're sitting on it. The biggest barrier to being able to do an IPO is the size, and being able to get a decent free float, and then making sure that there is enough free float in the markets and that the business is big enough that there'll be an aftermarket trade. That is the single biggest issue. So it's to IPO, a business has to be quite big. I mean, I think the general norm is you need a free float of $200 million. Now, I mean, that's 3 billion rand. That's the free float. I mean, you can already see, that's way out of where most private equity businesses market cap is, and that's the free float. So you double that for the size of the business. So I think it's a viable exit route if you're big. And I think the private equity industry, we're not playing at that level of size yet. So that makes it then more unviable.
So for you, a mid-market sized fund manager, would you see IPOs as being a viable exit option for your portfolio companies? You're on mute, Tshego.
Sorry. Yeah, and I think Natalie's already touched on some of the points. I mean, it should be a compelling proposition when it comes to exit, but it just hasn't been. And size is unfortunately an issue here. You need to be sizable so that the market can take you seriously. And the reality of it is that there's just that much capital out there in the market. So for an investor who's invested in an asset and is looking to realize value, there are other compelling buyers out there. So, be it a trade player or be a financial services player, there are other players who are willing to pay the multiples such that, you end up defaulting to those buyers. So it should be, but it just hasn't been. And I think that's just unfortunate. Yeah.
Gergana, your views?
Yeah, absolutely. It's definitely viable in that returns that you do get in instances that we've seen IPOs being successful and realistic are attractive, but it's really that size barrier that tends to be the issue. And even if you look at the mid-market option with the Altex to attract more mid-market companies to go IPO route, it hasn't really been that successful, which is why it's perhaps less attractive than going, trade buy route if you can.
Yeah.
And I mean, I was going to say, I was going to say it's quite disappointing because I actually think that private equity presents very compelling assets to market. I would think that when we sell assets, we sell much better assets versus assets that we bought. So just purely from a market point of view, I think you definitely need that, that offering. And unfortunately, it just hasn't happened. Yeah.
Yeah, and I think Gergana touches on a good point on the Altex being an option for maybe mid-market sized firms, but then the liquidity has been a challenge on that exchange. So, you list a company on the Altex and then you don't have the liquidity that most institutions are looking for. So certainly a viable option, but it has its challenges, and the size seems to be the theme that's weaved across from all the panelists. So let's see what the audience thought in terms of the most popular exit route. 38% of you thought that it was through a trade sale, and 35% was sale to another PE firm or financial investor. So a very close gap there between trade sale and sale to another PE firm or financial investor. Let's see what the actual answer is for this question. So the answer is sale to another PE firm or financial investor. Again, talking to the point made earlier by Gergana around secondary buyers and secondary exits. So very encouraging to see that there's a lot more activity now with PE firms being able to purchase assets from other PE firms. So very, very encouraging result there. Thank you for those results. We're going to move on to some further questions for our panel. Gergana, I'm going to start with you on this theme. So there has been a lot of activity around potential exits, but there actually hasn't been exits. So we've seen potential exits, but no real exits in 2020. What has made it challenging for fund managers to exit portfolio companies in kind of 2020, the past year, 2020, 2021?
Yeah, I mean, if we look at 2020 specifically, obviously COVID was a big factor. If we look at the previous volume of the survey where we'd asked, of the portfolio companies, what proportion have been negatively impacted, across the respondents. We had 39%, having that negative impact. And obviously, exit then doesn't make sense. So even if you were approaching that point to be well positioned for an exit, now you've got the curveball of COVID and the number of exits that have been postponed until the business can recover, until you can actually demonstrate that recovery and have enough of a run rate of what your new normal is, what your growth rate is. In instances where we do see portfolio companies benefiting from the impact of COVID, then the question mark is around sustainability. Is this a one-off effect that we're seeing, or are we going to continue to see this in the long term? And that's where the disconnect between buyers and sellers comes in, being able to put forward that equity story as a sustainable long-term equity story that you can get buyers to actually buy into at the right valuation becomes a bit of a challenge. And I think the other thing is with trade buyers, interest from international corporates has definitely reduced over the period. Because of COVID, because of the economy locally, the perceived issues and some of the real issues that we see in the local economy. And all of that has made exits that much more difficult, in this environment, and exacerbated some of the issues that we saw from previous periods that were coming through. But that being said, I think the exchange rate environment is quite opportune to be able to actually realize exits successfully, and it's definitely a good time to be entering that space, and hopefully we see that coming through in 2021 and beyond.
So valuations a challenge, and also international investors, again going back to the SA Inc. story there, but certainly our currency does stand in our favor in terms of us having attractive opportunities for foreigners. If they have a long-term view, certainly I think there's definitely opportunities for international investors. Natalie, I'm going to move over to you on exits again. So there's an existing perception, which we've all heard as fund managers, around the difficulty to exit in Africa. Do you think that this perception is also applicable to SA specifically? I mean, they've kind of grouped Africa as a whole to say that exits in Africa are very tough. Most LPs, or international LPs rather, have mentioned this. And how can we create a more conducive environment for exits in SA, given this perception by international investors?
Yeah, I mean, Sthembile, all three of you have touched on this. I mean, this, if private equity is exiting, by definition, someone's buying, right? And generally, we saw in the survey, it's a lot of it is to private equity, and private equity is often backed by international capital, or it's, as Gergana mentioned, it's international corporates that are looking to take a foothold in Africa, and they're also backed by, that's foreign direct investments into the country, and they've got choice, right? So when you're looking at South Africa Inc. as an investment destination, we really do not do ourselves any favor. And this is where, I do lay the blame solely at the feet of the policy makers here, because investors can operate in a difficult environment. They can operate in an environment that is low growth. They can operate in an environment that's got high regulation, but they cannot operate in an environment that's not stable. They want to know what's the size of the box that they're operating in. And policy changes and flick-flack around, whether it's licensing, whether it's around BEE legislation, we mentioned Burger King, stuff like that just absolutely scares investors off. And the other thing that investors want is security around the assets. They want to know that once they've invested, that the assets are going to be safe. And again, the riots that happened in the country, a month ago is also, it's just not helpful, right? So the private equity industry does and continues to grow and to develop fantastic companies. I mean, there are absolutely fantastic companies that the industry is producing. But if we're wanting exits, activity will increase if we become an attractive destination as a country, and that's what we have to fix. That's the number one thing we have to fix.
The certainty, certainly. So whether we are a low growth environment with all our challenges, if there's certainty on how you can operate as an investor, how you can exit and on your property rights, I think then it'll make it a more conducive environment for international investors. Couldn't agree more, Natalie. That certainty is really critically important for an investor to know how to operate and what parameters they are operating in. Tshego, I'm going to move on to you here. How have you navigated your exits in the past couple of years, and what have you learned? What would you do differently with your exits going forward in regards to some of the lessons learned, difficulties, challenges, positives?
It's an interesting question because we've in fact just concluded an exit of one of our businesses to a French multinational. I think the very first lesson that we've learned is your exit is actually part of your investment thesis. So, you know, when you make your investment at that point in time, you need to be very clear in your mind as to, you know, who the universe of buyers is likely to be. You know, you don't sit on an asset for 5 to 7 years and then at the end of it, hope that there's going to be people queuing, wanting to buy. So you need to pay attention to that, you know, right up front. And the second point that we've seen is that you need to leave something on the table for the buyer. You know, the survey reveals that most of the buyers are going to be either your trade players or your financial players. Those people are also looking for upside and blue sky. So if you're wanting to command a premium and you're wanting to, you know, attract some decent multiples, you need to be, you know, you need to leave something on the table for the buyer to make that investment case, you know, compelling to them. And then lastly, you know, what we have found is that I always say, you know, there's an inverse relationship between a glossy looking IM and the quality of the business. You just can't put a lipstick on a pig. You know, if it doesn't, you know, I think there's a lot of money in the market, but it's also smart money. Yeah. So you must understand that if an asset is not ready for sale, it's just not ready for sale. You know, go back, go to the drawing board, roll up your sleeves and just do a deep dive into the business and make sure that you fix it so that when it comes to market, people actually understand that you bring, you know, good quality asset to market. You know, as you know, the good old saying says, you only get an opportunity to sell your equity once. So, you know, when you get a chance, just make sure that you put your best foot forward. Yeah.
Absolutely. I mean, we've seen some of those assets that kind of go around and round. They come to market, then they go off and they come back as well.
We've seen the movie too many times. Yeah.
And you become skeptical when it comes back again, don't you? And essentially, you do have to almost look at your assets with a 10-year view, 5 years when you invest, and then 5 years for the upside for the person that's coming in. So I absolutely agree with your points around leaving some upside for your next investor. Natalie and Tshego, this question I'm going to pose to both of you. Has the challenging market around exits influenced the drive towards reinvestment activity and protecting the value of portfolios? Natalie, I'll start with you, and then Tshego, you can come in after Natalie.
Yes, I mean, I think that's definitely, I mean, you know, certainly through COVID, companies looked inward and they looked to support their companies. But I think through this process as well, what has happened is it has forced businesses to sometimes accelerate, you know, a strategic move that they may have been nervous to take, and COVID forced them to do it, you know, whatever that might be, consolidation, you know, something. So I do think there is, you know, there's been quite a lot of activity within the portfolio level space that often, I think, you know, if you've backed a good business, they've come out stronger at the other end of COVID. But I think the other impact of COVID, which we're seeing in the portfolio, is this point that I made earlier around the difficulty of understanding what sustainable earnings is. So I think what will happen is in private equity, we will see a delay in exit. So if we may have been planning an exit, you know, on our, you know, planning sheets to exit in 2019 or 2020, instead of going in 2021, you might say, look, let's take it for another year or two, so that when we do sell, there's like 2 or 3 years of sustainable earnings, that we're not having this difficult conversation around, well, was it COVID something, you know? So I think that delay and then reinvesting to have a more sustainable kind of 2 or 3 year track record to be able to meet buyers in the markets, I think will be a trend as well.
Your views?
No, very interesting. And the point has been well made around, you know, just businesses being inwardly looking. But what we've also found is that most of our portfolio businesses have also seized the opportunity because there's a realization, particularly by smaller businesses, that in difficult times, you perhaps need a bigger brother. So, you know, we probably have about, you know, 4 of our businesses that are looking at making acquisitions. And these are, you know, small, you know, medium-sized businesses that historically have been doing okay on their own. But, you know, as a result of COVID and what's happened, they've just been exposed. And, you know, they've reached a point where their management teams are saying, we actually think that, you know, if we're to partner or get into bed with a bigger brother, we'd be much more safe and we'd do that much more better. So there is an opportunity in all of this. Clearly, you need to do your homework because some people are wanting to offload assets because they realize that, you know, the longevity and the relevance of those assets in the market is no longer there. But there's definitely opportunity out there. Yeah.
Perfect, thanks. I'm going to take some more questions from our attendees and our audience. So the first one is, what is the key success factor, the one thing that will help a firm win in the game, for especially first-time PE fund managers in order to successfully raise capital from LPs? Natalie, I'll let you take that one. You seem very excited to take it.
Yeah. Look, I don't think there is a silver bullet. I mean, for a first-time fund manager, you know, I mean, obviously an established fund manager, the silver bullet is returns, right? I mean, that I think is the easy one. But if you're a first-time fund manager, when it depends who you're raising money from, but I think if you are raising money from the DFI community, which is a big part of who invests in Africa, they are very focused on ESG governance processes, etc. So I think being able to show that and have a proper answer to all of that and you know, legitimately show it, you know, just kind of you're not winging it, I think is really important. So getting these questionnaires from the DFIs early and going through them and making sure that your answers on those questions and putting the structures in place on ESG governance, you know, gender equality, etc. And really focusing on that is getting that right. Because I think what often happens is, you know, we're super excited about the investment opportunity and we run out and we kind of, you know, put the pitch book together and it's all about the growth and the trends in the markets and these are the sectors we're going to invest in and blah, blah, blah. And we don't always spend a lot of attention on this, you know, first-time fund managers. And then the DFI is kind of, yeah, thanks, but what about this? And then, you know, people are left scrambling. So getting yourselves organized on that back-end stuff for a first-time fund manager, particularly if you're looking to raise money from the DFIs, I think is important.
Absolutely. It's not just about the investment team and the investment thesis. It's also the back office operations. Agree there. The next question is on SPACs. So SPACs, though in existence for years, have become popular, especially in the US recently, as a way for tech businesses to raise funds and list. Is this a trend likely to happen or take hold locally? Or do we have other bigger things to worry about as a market? And this is from Mudiwa Gavaza from the Business Day and Financial Mail. Gergana, you seem to be nodding there. So I assume you have some views on this question.
I probably shouldn't have been nodding on that one. No, certainly. I mean, the SPACs is such a big story in the US, and it's really the level of activity that we're seeing there and how topical that is very interesting. And it's offering opportunities to private equities there because it gives them another exit route, and it gives another way for those businesses to go to the next level. In terms of capital, is it going to make sense in the local context? I mean, we do have some SPACs locally, but is it going to be a big growth story like what we see in the US? My gut feel, not really, at least not in the foreseeable future, because I don't think we've got the right sort of market fundamentals for it. But you know, could it be something that becomes a lot more topical in say 5 years' time? You know, depending on where the market goes, certainly. You know, if we see those trends continuing in the US, adopted in other markets, it is something that could make a lot more sense in our context. But I must be honest, it's a very niche space, and I'm certainly not an expert on it.
Tshego, do you have views on this?
Yeah, I mean, I think she's spot on. I think my view is that wave has kind of, you know, come and gone. Yeah, we went through a phase where everyone was going around town trying to put together and raise a SPAC, but the South African market just hasn't been embracing of it. Yeah, so if you're looking to attract capital, and maybe it's just the nature of our market, you know, there's just too much cash in the market, and you know, people are looking to deploy it, and this idea of having to, you know, put cash with someone, and you know, this thing is going to take time, and you know, the way you're being incentivized, I think the market's just not embracing of it. Yeah?
We've got another question here on, do you think private equity is becoming more attractive considering the perceived decrease in attractiveness of being listed? Tshego, I'm going to stay with you on this one.
I think it's still, you know, it makes for a compelling asset class. I think, you know, what we're seeing out there is a lot of entrepreneurs that are obviously, you know, still looking for that independence and ability to drive their own businesses. So, if you go into list, you must understand that there's outside scrutiny that you're going to have on the business. And if you're not ready for that, quite frankly, this is a perfect solution for you. And, the way we've approached it is to say we back entrepreneurs and allow them to, to run the business. And that ultimately is the real attraction, So I think it's still very much relevant, and it's going to become even that much more relevant going forward.
And just a related question, Natalie, which I'm going to ask you to take. How does one think about the key difference between private equity and listed companies from a retail or institutional investor perspective in terms of investment time horizon, costs, and sustainable returns for investors with a 7+ year perspective?
Yeah, so Sthembile, definitely, I think for institutional, obviously, I don't know why they don't give us more money, the institutions. For me, it makes absolute sense that and, I think this is a part where, certainly the South African pension funds, have not embraced private equity as much as we would have liked them to. So I think it absolutely makes sense from a diversification perspective for the institutional shareholders to come into private equity. The structures don't really exist for retail investments in private equity, and I don't know if it necessarily suits retail investors because of the way that it's tied up for as long as it is. Retail investors, may need the cash for emergencies or whatever. So I think private equity still very much is an institutional product, and I think it will stay that way. And it would be great to get more support from the institutions in South Africa, particularly the pension funds, because their capital is long term, and they are looking for diversification, away from the public markets, which is what they're primarily exposed to. So I think it's a great product for institutions, less so for retail.
No, absolutely. And the liquidity obviously also for retail investors, as you mentioned. If you want to come in and out as and when you have emergencies, it's much more difficult in PE. And the last question here is from Matthew, and he asks, have the SAPE market seen a positive effect yet of privatizing SAA and allowing companies to produce 100 milliwatts of power, or will this be more important in the years to come? I'm not sure what the first part of the question is, but I think if you can focus on the second part and allowing the production of kind of power for portfolio companies, have you guys seen that in your portfolio companies having a positive effect, or is it something that is still being considered in your strategies? Natalie and Tshego?
So, Sthembile, I think this is a great development. I think this is going to be a very positive development for South Africa. It's going to enable, manufacturing companies, particularly retail, whoever, a business to be able to, larger businesses, to be able to have a secure supply of power, which is absolutely paramount for economic development. So I think it's a hugely positive development. We haven't seen it yet. I think Actis is not heavily invested in the manufacturing sector, so I think that's probably where it's more relevant. But as a decision by governments, I think this is hugely positive for the industry.
Yeah, sorry, that was 100 megawatts, not milliwatts. Tshego, your views, have you seen it coming through in your...
No, we've definitely seen it. We've definitely seen it where particularly people who are exposed to the grid and to Eskom, there's a deliberate move to de-risk yourself away from that. Whether we're going to have private players developing, 100 megawatts going to be quite interesting. How much does it cost you to develop 100 megawatts? I don't know, 3.5-4 billion rand. So I doubt, there's any private player out there, unless you're in the business of developing, power plants, where you're going to spend 3.5 to 4 billion rand developing, a power station. So I don't know if we're going to see, people developing at that scale. But there's definitely been an uptake by manufacturers and industry to say, look, we need to de-risk ourselves. But also from a cost point of view, I think the cost of power and electricity is just shot through the roof. So there's a definite move to say, look, in order to contain that cost and make sure that we're in control of it, let's build a small, power plant, a small, call it solar power generator, to make sure that in the long term, depending on what happens with Eskom, we don't have to rely on it. Yeah.
Absolutely. No, I agree. Such a good development. So I'm going to go on to one last question, a final parting question for all our panelists. Just your prediction on the general trends in private equity for the next 3 to 5 years. Gergana, I'm going to start with you.
Yeah, it's an interesting one. Hopefully you're not going to hold me to the answers. We want to do a recap down the line. But I certainly think that the sector is going to continue to mature and competition is going to increase, and how players in the space respond to that is going to be quite important. And I think the way to respond to it is going to be around levers for value creation. We've seen some of that so far, especially on the operational side, but there's probably a lot more to do in terms of value creation at the portfolio company level. And I think as the maturity and the competition in the sector increases, finding new ways to do that is going to become increasingly important. The next thing that's going to feature is, just how do you approach your purpose of investment in terms of how it contributes to the world, to society, to the environment. It's going to be quite important with the mindsets of the new investors coming in, of what they're looking, to get out of it. We're going to see a lot more individuals potentially participating in the space, like we're seeing in the more developed markets through various technologically enabled platform that gives them access to the asset class, and they're going to have expectations of that impact investing and the purpose of investing as opposed to purely returns driven, which is where a lot of the psychology of the investor is going to. And then of course it's going to be the digitization, adoption of technology, both front office, back office, how you can do that to benefit the way you raise funds, the way you realize exits, the ways you source deals, the way you optimize your back office. So I think, we've already seen some of these trends coming through, and I think they're going to continue, growing over the next 3 to 5 years.
Interesting. So it's not just digitization for our portfolio companies, but also for the fund managers themselves. Very interesting. Natalie, your views on the trends in the next 3 to 5 years in the PE industry?
Sthembile, I think by far the biggest trend that I think we're going to see is this continuation of digitization, and it's going to be absolutely across the board. Not just necessarily in tech-enabled businesses, the VC space or digital infrastructure, which obviously we're investing in quite heavily, but even in the kind of more what we'll traditional businesses, like manufacturing or retail. Those businesses, I think, through the advent of these new technologies that are coming on board, will be able to transform themselves to become more efficient, to have different digital, distribution channels, etc. So I just think the world that we know now is going to be completely transformed, and the way that we do business is going to be completely transformed over the next 5 years.
Tshego, your views?
Yeah, so this is crystal ball stuff, so don't hold me to it. Look, I think we're going to have to... I'm
going to write it down, so I'm going to tweet it.
I think
2 years from now, I'm
going to... in September 2021. Look, I think we're going to have to step out of our comfort zone, as investors and as private equity players. I think the points made around, digitization, innovation, I think those are, very relevant. So when we're looking at investment cases and we're looking, trying to build our investment thesis, I think we need to think along those sort of lines. But more importantly, even post-investment, once we get into the underlying portfolio of companies, we need to ask ourselves those questions around, well, what is this business actually going to look like in the next 5 to 10 years? Because the way we've, kind of done things historically, it's clearly changing. So we're going to have to step out of our comfort zone and just allow ourselves to be a bit more creative and follow where the world is going. So that for me is going to be a trend that we see. And then second to that, I think we must accept that competition is just here to stay. And whatever you do, there's someone else who can do it much better. So you must embrace it, but also you must learn to box heavily and make sure that you're creative in how you do it.
Absolutely, some really great insights. Thank you to our panelists for the amazing conversation. Unfortunately, we don't have time for the other questions on the chat, but I think we've gotten some really great insights and conversation going with our panelists. So thanks, Natalie, Gergana, and Tshego for sharing your insights. I'm going to hand over back to Tanya just to close off the session.
Just a big thank you to the panel. Thank you for answering all the tough questions, whether it's from Sthembile or whether it's from the audience itself. Really appreciate your candidness, your honesty, and just your valuable insights in terms of the industry trends and what we're seeing. Sthembile, thank you so much for hosting. It was great to have you with us. And it also, I loved the beginning and the quick fire questions. I think it really set the scene to show that, you know, although these are really professional, serious investors, they also have a humorous side to them. So thank you for that. If you want to download the document, we've shared the link in the chat. It's also available on the SAVCA website for you to download. We will have volume 3 that will be released soon, and volume 3 is going to look at specifically the transformation of the sector and the focus on the individuals that make the sector tick. So we'll be looking at that a little bit more closely in the next volume. And once we've launched volume 3, we'll launch the full private equity industry survey report like we do every other year. Thank you everyone that joined us today. We hope you have a wonderful evening. Stay safe, stay warm, and see you at the next event.